Welcome to The Explainer. Today, we're diving into startup wealth and risk, the core mechanic. We are looking right at the engine of massive wealth creation, the startup ecosystem. Now, I know the mechanics of startup wealth are usually completely buried in complex term sheets, capitalization tables, and just opaque jargon. But honestly, the absolute core of this whole system boils down to one straightforward, incredibly powerful concept. It's the fundamental mechanism that lets venture capital generate returns that just consistently blow traditional asset classes out of the water. Okay, let's dive into this simple but powerful idea, because that foundation rests on a total paradigm shift in how we actually think about earning. For most of us, right, income is linear. You trade your time for a salary. But in the startup ecosystem, investors do something completely different. They exchange capital for equity, and that single shift, that moves your earning potential from linear to exponential. By holding a percentage of a private company, your wealth isn't constrained by the hours you can physically work anymore. Instead, it's tied to the limitless potential of the company's valuation. It is a massive structural transition from just earning wages to actually owning growth. When we strip away all the noise, the entire strategy is really just a logical two-step journey. Step 1, you acquire a small piece of a startup early on, usually during those nascent, unpriced rounds. You're stepping in when a company is literally little more than a pitch deck in a promising team. Then comes step 2, which honestly demands extreme patience through long periods where your money is completely locked up. You hold that equity as the company tries to find product-market fit, scales up, and fights off competitors. And the wealth is finally realized much later through a liquidity event, like an acquisition or an IPO, where you sell that early high-risk equity at a vastly multiplied valuation. So you aren't timing daily stock market fluctuations here. You are betting on compounding private growth over a decade. But we do need a reality check here. There is a brutal statistical reality tethered to this potential for massive wealth and high rewards, and that is the extremely high risk. We are operating in a domain completely governed by the venture capital power law. The risk isn't just that a stock might dip a few percent. No way. The reality is that the vast majority of these ventures, often up to 90% of them, will go to absolute zero. Because of this extreme failure rate, the very few outsized winners in an investor's portfolio have to generate returns large enough to not only cover all of those losses, but also return a massive profit to the fund. You're essentially hunting for rare outliers in a landscape literally built on failure. So, how do you survive a landscape where 9 out of 10 investments might fail? Well, as the saying goes, the smartest investors always study before they invest. It takes way more than just passive observation. The only real antidote to this extraordinary risk is rigorous, almost obsessive due diligence. It involves building a deep investment thesis, doing intense market sizing, and stress testing unit economics before those economics even exist at scale. And perhaps most importantly, it requires evaluating founder psychology. You have to assess whether the leadership team actually has the grit and the adaptability to pivot when their initial assumptions inevitably break. This deep structural analysis is exactly what separates a highly calculated venture bet from, a mere gamble. Which brings us to a fundamental paradox at the very heart of all this venture investing. Think about it. If the goal is to acquire early equity at a specific price, and your success depends on intense due diligence, how do you actually price an asset that has zero revenue, no finished product, and sometimes no actual customers? It's a fascinating intellectual leap. Before a single dollar of capital even changes hands, someone has to attach a multi-million-dollar valuation to what might essentially be an idea sketched on the back of a napkin. That valuation mystery, the financial alchemy of pricing the totally unproven, is exactly what we're going to uncover in our next explainer. We'll dive deep into the specific frameworks and negotiation tactics used to value early-stage companies. If you found this explainer helpful, definitely share it with your friends or classmates who want to understand business, and subscribe for more simple business and finance lessons. Until next time, leave yourself with this question: what is an idea truly worth before it becomes a reality? Thanks for joining me.